Hey everybody, Smart Silver Stacker here. Hope you're doing well. Hope you're doing better than the US banking system because it appears to be in trouble once again. We've got First Republic Bank, the new problem bank here in the US. The share price of First Republic dropping about 50% in trading yesterday. Today at the market open, down another 20% or so. So a lot of pain for shareholders over at First Republic Bank. And it's a very similar problem to what we saw last month with SVB. Depositors are withdrawing funds. The bank is being forced to sell assets to make up the difference, and those assets are being sold at a loss, and the markets are not liking that. So very likely we may see some bailouts in one form or another for First Republic Bank here in the very near future. And this banking crisis, this instability here in the US, along with the global geopolitical situation, is largely responsible for why right now there is a record amount of interest in the precious metals as a safe haven. And we're going to go over some data today which demonstrates that. And while this financial crisis and the likely response from the Fed and the Treasury will ultimately end up being very bullish for gold and silver in the long run, at the moment there is some danger in these markets. And so I want to go over that as well because it might not be quite what you expect. So stick around, it's going to be a great video. We got a lot to cover. Let's get to it. Did you know SD Bullion is giving away a monster box of 2023 Silver Eagles? Find out how you can enter at sdbullion.com/sweepstakes. Okay, so here's the chart for First Republic Bank. You can see we're a few minutes after market open here, 9:54 a.m., and it's down 21.73%. So a pretty nasty open, especially when you consider the market action yesterday. We saw the price of First Republic Bank, ticker symbol FRC, drop by nearly 50% yesterday. So on Monday, the stock was trading above 15 bucks. Today, under $7. It's $6.34 per share. So a huge loss. Oh, look, it's ticking down even more as we speak. So very bearish action in this stock. The precious metal is kind of liking this, it seems like. We got a little tick up in gold here. Markets across the board ticking up on this news. About 1% gain in both gold and silver. And the likelihood of a bailout for this troubled bank seems to be growing, and that could explain why there's a little bit of exuberance in the precious metals. Although, of course, not massive gains here or anything, but they're green on this news. Now let's talk a little bit about what's going on here. So here's a report from Reuters. First Republic Bank shares plummet day after hitting record low. So that's talking about this morning. I think that this came out during pre-market trading. And it's pretty simple what's going on here. It's very similar to what happened with SVB. We've seen an outflow of more than $100 billion worth of deposits in the first quarter of 2023. So not as rapid an outflow as Silicon Valley Bank, but nonetheless, it's still $100 billion of deposits taken out of the bank. And David Wagner, he's a portfolio manager at Aptus Capital Advisors. He tells us that the First Republic assets will be sold, but it may take some time and could be sold at a pretty severe discount to par. Now, this is exactly what happened at SVB. They had a big withdrawal of deposits. They went to sell their assets, and they had to take a big haircut on those assets because what they were selling was U.S. Treasury bonds that were yielding a low rate. So with the bond market, the way that the price of the bonds work is as rates go up, the value of existing bonds declines because the newer bonds, they have a better yield, so they're worth more. And so what happened was SVB took on all of these treasury bonds when rates were near zero. Now that they're significantly higher, the bond portfolio had a lot of unrealized losses. And when bank is forced to sell assets to give liquidity after depositors take money out, then if they're forced to sell them for a loss, that can be a huge problem. Clearly, the market not liking this situation over at First Republic Bank. And this is no surprise. We had this report from the end of March from Fortune telling us that U.S. banks are sitting on $1.7 trillion in unrealized losses. Now, a lot of these banks have these low-yielding treasuries, and it seems like their exit strategy is just to hold the bonds to maturity because then they will get face value. But if they're forced to sell them before that time, then they are going to have to take a haircut on them. And if depositors get antsy, which apparently they are over at First Republic Bank, they're trying to get their money out of these institutions, it can cause a cascading series of bank runs. And so, we're not out of the woods yet, despite all of the talk from the Federal Reserve and the Treasury about how the banking system is stable, the banking system is well capitalized. Clearly, that's not the case, because we are continuing to see contagion spreading now with First Republic Bank. And I'm suspecting that we're going to see a big increase in this. This is the Federal Reserve balance sheet. And you can see there was this huge spike up as the Fed instituted its bank term funding program following the collapse of SVB. What this program allowed banks to do is to take these troubled assets, these treasuries that have this low yield and have all these unrealized losses, put them up as collateral for loans from the Fed, but they could put them up at face value, so at more than their worth in the marketplace. So they could put up the collateral, get the liquidity, and this was the Fed's way of bailing out the banking system. And, they said, well, it's not, an injection of capital, it's just a loan. That's all it is. Of course, the thing is that they're taking collateral for these loans that isn't worth what they say it is. They're taking it at face value when in reality in the marketplace it's worth significantly less than that. But I would not be surprised if in a week or two we see this balance sheet spike back up. You can see it's come down a little bit since the SVB intervention there in the institution of the BTFP program, but it's not as low as it was. We're still, you got to go back to, I don't know, this is a little small on my screen here, but it looks like November to get to a time when the when we were at the same level on the Fed balance sheet. So this spike up, it wiped out months and months of quantitative tightening, the drawdown in the Federal Reserve's balance sheet. And now it's looking like there's going to be something which may force the Fed to take more assets, more troubled assets onto their balance sheet. And that would be the assets over at First Republic Bank. And I made this forecast when SVB collapsed that we would see on the Fed balance sheet $10 trillion before we ever see 8. 8's down here. Right now we're at about 8.6 trillion, and I don't think that the Fed has a chance of reducing their balance sheet down to $8 trillion unless they want to collapse everything, which is likely what would happen if they began selling off these assets or denying the banks these loans with these troubled assets as collateral. Now, this is an interesting chart that I want to draw your attention to. This is the Google Trends chart for the search query how to buy gold. So this reflects how frequently people are searching for that term. And you can see that in April of 2023, so this month, we have approached the record high for this chart. We're at a 95 right now. Now, this is on a scale of 1 to 100. 100 representing the highest level of search volume ever for this term, 1 representing the bottom. So this goes back to 2004, and you can see the only time on this chart that there was a higher search volume was in 2011 here, and this was when we saw a big spike up in the price of gold. Now, I would say that this chart may be bullish in some ways for gold. It shows that interest in the precious metals is up, but also I think it gives us reason to be a little bit circumspect and a little bit cautious with the precious metals here, because we have seen a big spike up in interest. So that is getting priced into the market. People are buying into gold in a big way. How many people are left out there? Now, I do think that we will exceed the interest in gold from 2011 this time around, but I also think that when you see the interest in gold spiking up like this, along with the price approaching new all-time highs, you need to be a little bit cautious. Now, if we look at the chart for silver here, how to buy silver, you can see that we're only at about a 63, and that the search volume this month is still dwarfed by what we saw back in 2021 during the silver squeeze. That represents the most interest in silver ever, how to buy silver. And there was also a spike up in 2011 when the price hit nearly $50, but we haven't approached either of those peaks yet this month. So interest in silver is still lagging behind, but that is normal. Early in precious metals bull markets, interest focuses on gold. You see that move up. Once that gets a little too expensive, then investors start looking towards silver. And silver is a much smaller market than gold. So when interest in silver picks up, the price can move very rapidly. But there are some other charts that I want to take a look at that show us that there is some reason to be cautious here, a little bit circumspect about the price of the precious metals. This comes from clivemond.com. So Clive Mond is a technical analyst. He specializes in the precious metals. This is from his latest gold update, which he releases every couple months for the public. He's got a subscription service if you want to see more of his technical analysis. But this is an interesting chart. This is the 6-month chart for gold. And you can see that he's drawn this range here and then a dome under which the gold price has been appreciating. And his theory here, or what he's telling us in this latest gold market update, is that in the event that we see a sell-off in the broad stock market, the price of gold could drop back further, probably to the lower end of this channel that he's drawn. So that would be a drop back down to around the 1900 level. And I suppose in a market crash, a broad market crash, it could drop further. And the thing we have to worry about here when we see the banking crisis rear its head is that, yes, bailouts ultimately in the long run are bullish for the price of the precious metals because they're highly inflationary. But in the short term, if confidence gets rattled in these markets and we see a sharp sell-off, sometimes the precious metals do move in lockstep with the markets downward. That's what we saw in 2008. Of course, that was a setup for a huge rally into 2011, so that decline in 2008 was a buying opportunity. And if we do see a drop in the precious metals here on general market weakness, I would also view it as a buying opportunity. And also, I want to comment that one thing we might see if we do see a decline in the price of gold is that the spot price may fall. But I think that physical metal, the premiums on that, the real price of actual physical gold and silver as well, may not move much. I mean, the premiums may just go up a lot to compensate for the falling spot price, because I think that the physical metal is going to be a much better store of value than the paper derivative futures contracts or stocks or ETFs, that sort of thing. Another chart from that update that he shows is the 5-year gold chart, which shows that gold also may be set up here for a bit of a fall. It has reached this long-term resistance level. We've seen it decline from this level several times over the past couple of years, and we may well see that again. Kind of corroborates his theory from the 6-month charts. But the other thing I will say, if we do manage to see a close above this resistance, say we get to $2,100 and we close above that, then it's probably going to be off to the races for the precious metals. And so, I don't think that selling metals is the approach to take here in light of this potential drop that we may be seeing in the short term. And of course, none of this is financial advice. I'm just telling you my thoughts on things. I'm not telling you what to do. But I think it does tell us that maybe you might want to lighten up on paper positions if you've got some ETFs or things like that, so that you can trade a little bit and benefit from market volatility. Or at the very least, you might want to have some dry powder ready for a increase in your physical positions should we see a drop back down. And if we really see it tank, you can see the long-term support here for gold is down around 1700, 1650. So, that would be a huge decline. If we do see a fall like that, I think it's very unlikely that you'll be able to get physical metal for anywhere near that price. I think the premiums will absolutely explode, but it is something to be aware of. And there might be some deals in the near future, even if premiums move up. If the spot price falls enough, you might be able to get physical metal cheaper than you can today. So I think having some dry powder is not a bad idea. And the other charts I want to draw your attention to, the commitment of traders charts here, latest data from April 18th, so it's not entirely reflective of the situation that we're in right now. Both the gold and the silver charts, while they're not at extreme readings here, we don't have extreme short positions from the commercial traders or extreme long positions from the large speculative traders. Both of these charts show us that there is some room for a pullback in the price of the precious metals here. So, I'm not much of a technical analyst, but Clive Mond does a pretty good job with the precious metals. I'd be curious to know what you think. How do you think this banking crisis with First Republic Bank is going to play out? The share price still dropping, down 25% now at the end of this video. We've dropped almost another 5% over the course of this video. So it's not looking good for First Republic Bank. But do you think we're getting more bailouts? Do you think we could see a pullback in the precious metals? Or do you think that they're just going to spike up on the uncertainty as individuals out there, investors, stackers, look for safe havens? I would like to know what you have to say, so leave me a comment down below. And thank you all very much for watching. Stay safe and happy stacking, everyone. Smart Silver Stacker out.